Muted.
And welcome to today's First Property Group plc conference call with the CEO and CIO. Throughout this call, all participants will be in listen-only mode, and afterwards there will be a question and answer session. Just remind you, this session is being recorded. I'll now hand you over to Ben Habib. Please begin.
Good morning, everyone. Thank you very much for joining us this morning on the announcement of our interim results. I'm joined in the room by two of my fellow directors, George Digby, Finance Director, who will take any questions you've got on the finances, and Jeremy Barkas, our Development Director, who is responsible, amongst other things, for raising new money for the group. So any questions to do with the development of the business, I'll hand over to Jeremy at the end. But I thought for expediency and clarity of presentation that I would do the entire presentation on my own, which I intend to keep quite brief, and then open up to questions as soon as possible. There is, I'm told, a copy of our interim presentation on the website, so you should be able to follow what I'm saying by logging on to www.fprop.com, and it should be fairly self-evident what you need to look at.
It's the second from the right column down, labelled Investor Relations.
Investor Relations. Anyway, I'll talk you through the results. I think it should be fairly clear if you go to the website. Looking at the results highlights to start with, this is page 5 of the presentation if you're able to track it down. The results, I think, in summary, can be described as steady as she goes. Results obviously look back. They don't look to any of the profit-generating steps that the group has taken during the period. And as a result of that, the results look sort of flat compared to last year, because there wasn't really much that was done in the second half of last year that resulted in incremental profits for the first half of this year. So profits are down slightly because in the prior year we sold a property and we lost therefore the benefit of that property's income, and last year's profit was flattered by the profit we made on the sale of that property. So pre-tax profits down slightly as a result of that sale last year. Diluted earnings per share down a similar percentage as a result. The group, however, remains in very good shape. We're very excited about the future, which I'll come to in a moment. So on the back of that confidence, we are maintaining our dividend, notwithstanding the slight reduction in profit. Profit before tax from fund management, very similar to last year. And then profit before tax from group properties are down, and that's the element of our business which has experienced a reduction in profit as a result of the sale of that property last year. The profits are not down for any untoward reason, just simply because we sold a property last year which resulted us in holding more cash, and as we all know, cash doesn't yield anything nowadays. The average FX rate for euro to sterling, which is important to us because 70% of our assets are held in Poland, was 1.17 during the period, which is a better average rate than the period last year, which resulted in profits being increased, as it were, by about £112,000, and we ended the period at a slightly better FX rate as well. Net assets at the end of the 6 months to 30th September up from last year at 19.5 million roughly. Cash balances 10.6 million. It's worth just looking at the cash. It looks like it's down about 1 million, but actually in the first half of this year we invested 3.4 million in buying 2 office properties in the UK. So on a like-for-like basis, if you like, you could argue that our cash, had we not made those investments, would be about 14 million, and 14 million versus 11.77 million, having paid dividends on the way, is a testimony to the cash-generating capability of First Property Group. Total debt in the business very similar to last year, and the slight increment is as a result of the euro-sterling exchange rate movement that I've already mentioned. Assets under management down last year, partly due to a 5 million decrease since 31st March as a result of FX movement, but also partly due to a drifting down in the values principally of our Polish portfolio, The income generation on our Polish portfolio remains high and robust, but as a result of the second leg, as it were, of the credit crunch and the sovereign debt crisis in Europe, which took place between the second half of 2011 and during the course of 2012, capital values have been hit. The real economy in Poland I'll come to in a moment, but the portfolio in Poland remains in good shape, but for the fact that capital values have slipped. That basically paints the picture of where we are at the moment, looking back over the last 6 months. So what have we done in the last 6 months in order to look to the future with the excitement and optimism to which I referred? The three things we've done really is the purchase of the 2 office properties in Bracknell and Woking, which we paid 3.4 million to buy, including costs. We've now got planning permission to convert those office blocks to residential use, and it is our intention to sell them during the course of the second half of the year. And we believe that the value of those properties has gone up substantially since we bought them, and therefore on a sale we should experience a significant profit which would flow through into the second half of the year, and therefore the full year results. The other thing that we've done, which is a very positive step for the group, is the establishment of a new 5-year partnership with a leading investment consultancy business, which has invested £12 million so far of equity in this new partnership with us, with a view to increasing this to 40 million in the near future, to do exactly what we've just been doing with the Bracknell and Woking properties. So that is to go out and buy office blocks in the UK. We're broadly targeting the southern part of the UK, but we're agnostic as to geography as long as the mathematical equation stacks up, with a view to getting planning permission to convert them to residential, and then either selling them with the benefit of planning consent or implementing the planning consent and building them out. And we'll take each opportunity as it comes and decide what the best business plan is for a given property as we do that. The opportunity arises for us as a result of 2 things really. The first is the relaxation of planning policy by the government. The government has very wisely, and I think it's one of the best initiatives this government has produced for the property industry, very wisely deregulated the process by which you get planning permission for conversion of offices to residential. A lot of local boroughs, in my view, wrongly have been hanging on to office blocks in their local boroughs, in part perhaps to retain the payment of rates. But there is a surfeit of redundant office space in the UK, and it ought to be put to better use as the working habits of our inhabitants change. So I think it was a very sensible thing for the government to introduce these permitted development rights for conversion of offices to residential. The scheme lasts for 3 years until 31st May 2016. So there's a limited window of opportunity to implement this, and we will be working our socks off to do our best for this fund during that period. Then the third thing that we've done, which will add to profitability going forward, is the increase in our investment in the Blue Tower in Warsaw. We used to own 28.5% of it. We now own 48.2%, having increased our share by 19.7%, and that should add about another 100-odd thousand in the second half of the year. And I think we've publicised a figure of 460,000 euros of forecast earnings from this increased investment per annum, so that translates into about 350,000 sterling, plus a bit perhaps, give or take a fair or headwind, coming off that increased investment going forward. So there are 3 steps we've taken that demonstrably should add to the profits of First Property Group and therefore the strength of the company. Behind these 3 steps that we've taken, we are also working on a number of high-yielding investments in Poland, none of which we've been able to secure in the first half of the year. but we continue to work on them, and with a fair win, one would hope that we will secure some of those going forward. And again, each of those would be of incremental benefit to our profit line and the strength of the group. Looking at the dividend, as shareholders will recall, we believe in paying dividends even though we do think we're a growth company, and profits have been steady for the last couple of years, and so dividends have been more or less steady. But if we're able to increase our bottom line on a sustainable basis going forward, which I very much hope we are, we will obviously take a progressive view to dividends and increase our dividend as we go forward. I say this every time I present, but I am very proud of the fact that First Property Group has gone through the entire credit crunch without raising a single pound from shareholders in order to survive the credit crunch. And during that time it has remained profitable throughout and has paid an increasing dividend throughout. And I'm not sure if that puts us into unique territory as a property company, but it certainly puts us into fairly rarefied territory. And I'm very proud of that, and shareholders should, I hope, be pleased with our performance. Looking to the group on a sort of breakdown basis, funds under management have been relatively stable over the last 3 years, and resulting from that, our earnings from funds under management have been more or less stable as well, give or take FX rate and slight slippage in value of properties under management. And the profit we earn from group properties, again, has been more or less stable, ignoring one-off events. So in 2011 we had a one-off profit of 213,000, which didn't repeat in 2012, and then the sale of the Mokotov property in 2012 resulted in profits in our group properties dropping again in 2013. But I think we'll see quite a marked shift in profitability of group properties going forward as a result of the initiatives that I've just described. We have 7 funds under management at the moment, the most recent of which we call Fprop PDR, and is the fund that has got the £12 million to buy office blocks and convert them to resi. And as I mentioned, that 12 million we hope will be increased to 40 million fairly soon. But the 6 funds that we managed during the period are basically the 6 funds that we've managed for a number of years now. The largest of those funds is the USS Fprop Managed Property Portfolio, which I know all shareholders with an interest in the group will be acutely aware of, given its maturity in August 2015. And we are in discussions with USS for a resolution to that fund, and I'm certain that 2014 will bring forward that resolution. I'm sanguine about the effect that the expiry of that fund might have on First Property Group, because I think we've got a number of initiatives afoot already and are working on others which will I think result in our not missing the income on the USS fund after its expiry. Moving on, I'm going to skip a few pages because I think I've touched on quite a lot of what's on the next few pages of the presentation, but I can obviously take questions on any of it as we go forward. On page 13, I suppose it's just worth mentioning that Fprop Opportunities PLC FOP is the entity which we will be using to buy these high-yielding properties in Poland if we're able to secure any of them. We used to own 84.1% of FOP last year. We did a capital raising in April this year which reduced our interest to 76.2%, and that accounts slightly as well for the reduction in profits earned from group properties. But we've got no intention of diluting our interest in FOP going forward until it is fully invested. And that, I think, brings us to the end of section 1 of the presentation. Just looking at the market in which we operate, Poland continues to do really remarkably well in an otherwise turbulent Europe. its economy has slowed down as a result of what's been going on in the capital markets in late 2011 and 2012, and the general slowdown across Europe. Its biggest trading partner is Germany, and Germany has slowed down, so Poland's economy has slowed down. Its nadir appears to have been the first and second quarter of 2013, when GDP growth dropped down to about just sub 1%. GDP growth is now picking up in Poland. Consumer spending is picking up. PMI figures out of Poland are all positive, so exports seem to be picking up. The current account deficit is under control. Poland was admonished recently by the EU for having a larger budget deficit than it should, but I think that is rather the pot calling the kettle black. Poland is in very good shape. It's got total government debt of sub 55% of GDP. So we think that our belief in Poland over the many years we've now invested there is vindicated by that country's good performance through the credit crunch and its continued good forecasts. So we've got no real concerns over Poland. As far as the property market is concerned, it has been buffeted by what's been going on in the capital markets over the last year and a half. But again, we expect the income side of our story, which shareholders will recall is the part of the story on which we place greater emphasis, because you can look at income with greater certainty than you can at capital values. And if you're a long-term investor, you can actually pick your moment for exit. And income coming out of Poland is robust on our property portfolio. It's earning about 26% per annum on a pre-tax basis on equity, which is damn good. And we think that positive income story for Poland should continue as long as its macroeconomy continues to do well as we expect it to. The property scene may not be ideal from a capital value perspective at the moment, and that does obviously lead to us being cautious in what we buy and how we bid for property, but it gives us confidence in investing in Poland. The UK, on the other hand, has been hit fairly much harder than Poland, very hard, I'd say, during the credit crunch, but the pickup in the London market that's been going on for the last 2 years, which has put London, and I said this every time we speak, put London into bubble territory. Still waiting for the bubble to burst. It seems a resilient bubble. But London is, in our view, in bubble territory. But that sort of boost to London is now moving out to the regions, and we are seeing greater institutional interest in secondary property in the regions. And so we do think that over time, well-let secondary property in the region should also pick up in value. So far, the UK recovery in property values has been restricted really to prime property in London. But I think we'll see a broader correction upwards across the UK. The big story in the UK market generally at the moment is the residential market with the government's new Help to Buy scheme. And that really dovetails with our strategy to buy office blocks and convert to residential, because the Help to Buy scheme has injected an enormous amount of cash into the buying end of the property market for residential properties, and we obviously buying offices are buying at the supply end. So the fact that we've got a ready-made demand for the product we're producing bodes extremely well for Fprop PDR, this new fund that we've just raised. And whether or not you believe in the Help to Buy scheme being good for the UK economy or otherwise, the fact is it is going to result in UK residential prices going up for at least the duration of that scheme and possibly beyond. Fprop PDR hopefully will do well on the back of that. And I think I have more or less covered everything in the presentation so far. There's some appendices which you may wish to look at in your own time. I don't intend to go through them unless anyone has any specific questions on them. So I think, having said all of that, can I now open it up to questions both on the telephone and in the room?
Thank you. Telephone participants, if you would like to ask a question, please press 01 on your telephone keypads now. You may press 02 to withdraw your question at any time. There'll now be a brief pause while questions are being registered. While we're waiting for questions from the telephones, are there any questions in the room?
Any questions? David?
I just wondered how confident you are on sourcing further office to resi opportunities. There's obviously a market that's been recognised. It's a limited life. Presumably you've got more competition now that people have seen what's possible.
Yeah, we certainly have got more competition, and definitely office prices in the regions have risen on the back of this new government initiative and the Help to Buy scheme. But what is very interesting, and perhaps this ought to be, if the Chancellor is listening to this telephone call, his next move is, if he really genuinely wants to boost supply, it's not sufficient simply to deregulate the planning policy. That's a big step forward to deregulate planning. But he needs to inject capital into the development end of the market. And so what you've got at the moment is a lot of demand on the resi to buy completed units, but an absence of funding for development properties. And irrespective of the talk you might hear from the big banks, actually they're not there to lend on development properties. They're still very shy of non-income producing properties. And that constraint of capital at the supply end does mean, Chris, that even though property prices have gone up, office prices have gone up, I don't think they'll go up sufficiently to undermine Fprop PDR's business plan. When I used to develop offices to resi, or when I did any developments, frankly, in the 1990s, we used to work off a margin of 15% of forecast gross development value. During the peak of the boom, that dropped to somewhere between 7 to 10% of GDV. And I think it's now out at about 20 to 25% of GDV. So there's still a lot of healthy profit margins to be made because of this constraint in capital at the development end. So whilst the lowest hanging fruit are probably gone, there's still a big surfeit of office property out there, and there's a constraint in capital, and I think that will serve to allow us to discharge our business plans.
Presumably you won't be buying anything in London?
No, it's unlikely. London suffers from two problems. The first is the well-publicised problem of inflated property prices, but the other problem is that a lot of the London boroughs have applied for exemption, did apply for exemption from permitted development rights. Many of them succeeded in getting exemption, and those that didn't succeed are appealing the position. So London becomes quite an uncertain hunting ground for a developer looking to implement such a plan. I think it's better received in the regions where local authorities were less vociferous about defending office use in their boroughs.
I mean, as I understand, they can still put obstacles up. Even though the sort of core obstacles are removed, they can still make life difficult in terms of other planning regulations and spaces and things like that. Was that your experience with the ones that you did, or was it quite amenable?
No, I mean, I think not our experience. That does, we've only done 2 so far. Yeah. But that hasn't been our experience. There is a shortage of housing in the UK, so there is a desire.
The logic is great, but it's just, planning process is frustrating at the best.
Yeah, I mean, clearly it makes sense, Chris, to target properties which lend themselves physically to converting to residential, and perhaps ideally even look like residential property to start with. And so the Woking property we bought, if you look at it, it actually looks like a series of blocks of flats already. And each office unit was 600 square foot. It couldn't have been more convenient for us as a prospective purchase. But I think it's very hard for a local authority to resist granting consent for a change in the facade, assuming it's not in a conservation area or sensitive sort of planning area. It's very hard for them to resist something as benign as that, having granted consent for the fundamental change of use. And they're obliged. It's a tick box exercise. If the property complies, they are obliged to grant consent. So it would be vexatious, I think. It would be seen to be vexatious from an appeals process if they were putting obstacles in the way of a property that demonstrably should be granted consent.
The other problem's highways and roads and that kind of thing.
Yeah, well, there's 3 categories you've got to comply with in order to get your consent. Your office block mustn't be in a floodplain. It mustn't be contaminated. mustn't be contaminated property, and there must be adequate parking, and it must comply with highways regulations. So there's got to be adequate parking, visibility displays, access, egress, all that kind of thing.
I think first floors upwards should be all right from the floodplain bit, shouldn't it?
Well, you've got to have a safe means of escape from your property. So it's not sufficient. I mean, you know, obviously you can restrict your development to the upper floors, but you've also got to be able to get your occupants in and out of the property in the event of a flood. So, you know, those are the three tick box exercises you've got to comply with. Most office blocks come with more parking than you need for resi.
Yeah.
Any other questions?
The other thing about converting is if you convert them to student accommodation, one may not get as much back. The income is probably pretty interesting, and they're less worried about the facade of a building.
Yeah, I'm not sure student accommodation is caught by the permitted development rights. I think it might be a separate use class.
Yeah.
So I'm not sure that will work.
You can't do that.
No.
I mean, you could do it, but you're back to
normal planning process. Yeah. So any other questions on the telephone?
Okay, we have no questions on the telephone lines at this time.
Great. Well, thank you very much, everyone, for listening, and look forward to reporting again to you in June. Thanks very much. Bye-bye.
This now concludes our call. Thank you for attending. Participants, you may disconnect your lines.